Hi everyone, welcome to today's webinar with me, Fawad Razaqzada, and my colleague Victor. And this is
Greetings.
hi Victor. How are you doing, mate?
Yeah, well, very excited now that we have some volatility back in the markets.
Indeed, we
Uh,
saw a big sell-off on Monday. Markets have bounced back quite strongly today, but let's see. We've got a few things coming up: the FOMC meeting on Wednesday, and a few other central bank meetings that could trigger further volatility. So it should be some exciting times in the markets, and
yeah,
we'll
certainly.
discuss all of that in a minute or so. Let's just remind everyone that this webinar is live. So for those of you who have joined us, welcome, and we hope that we'll be able to share some really good ideas with you guys. For those of you who are watching this on YouTube, please consider joining us live next time so that you will have the opportunity to ask us questions. Um, so the first thing we do is read the risk warning. It's very important that you are aware of all these risks. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, what we're looking at then today, Victor, what's the most important market to start off with, would you say?
Well, I'm very positive that the stock market is the most interesting one at this moment.
Absolutely.
However, I do expect currencies
Yeah.
uh, and commodities like precious metals really to be a very dynamic
Yeah.
in the coming days, especially considering the Fed language tomorrow,
Yeah.
which we're yet to hear. But yeah, let's elaborate a little bit on the calendar.
Yeah. So yeah,
We
the
do have
FOMC.
we do have some housing starts data today, which could be important, and then tomorrow is the big day with the FOMC and the BOJ for that matter. Press conferences. We're going to be listening to Jay Powell carefully, and signs from the Bank of Japan are to be monitored. We're seeing some selling in the yen this morning, something that could be a precursor to some tentative shift in policy
Sure.
towards, well, you guessed it, a more easy and even easier monetary policy in Japan.
Well, that is
That's happening due
unless.
to a
Yeah.
change of government and some expectations that the new fraction of the LDP, which is about to nominate their prime minister,
Yeah.
could be tilted on a more dovish side, and we're going to see something even more drastic than Abenomics, which
Sure.
last
Is
time was introduced, that caused havoc for the Japanese yen.
Yeah. Is this why the Nikkei has been able to outperform the global equity markets in
Yes,
recent times,
yes,
would you say?
I imagine so.
Yeah.
This is that the rally started as the previous prime minister resigned.
Yeah.
So let's see what happens.
Um, you mentioned yen crosses as well. We'll come back to that in a minute or so. So obviously, everything with the Japanese yen and Japanese stocks, it's all, obviously the Bank of Japan meeting is going to be important, but I would say even more important would be sentiment towards risk, because Japanese yen is
Of
deemed to
course.
be a haven currency, and so if the stock market selling resumes, then we may see elevated levels of demand for the Japanese yen. FOMC meeting, very important. We have the economic projections or the dot plots to look forward to, as well as the press conference. So this should provide us with lots of movements in the markets, depending on the language the Fed chair is going to use at the press conference and at the statement. It will be very scrutinized very closely, as Victor mentioned. We also have a couple of other central bank meetings. The Swiss National Bank, the most boring central bank, right, is meeting on Thursday morning ahead of the Bank of England. The Bank of England is coming under pressure from all angles to start normalizing its policy. The economic data in the UK has been improving. Vaccinations has been a success in the UK. I would say, but more to the point, inflation is on the rise, not just in the UK but globally as well. But here in the UK, it has risen to 3%, which is 1% above the Bank of England's 2% threshold. Or 2% target, I should say. So previously the Bank of England were unanimous in deciding monetary policy. In terms of interest rates, and I think that's going to be the case once again. But in terms of asset purchases, there was one dissenter last time, and the market analysts are expecting another this time to also for that to be unchanged. But we may see more dissenters at this particular policy meeting, and if that's the case, then we could see the pound rise a little bit more strongly.
Yeah, and it's already kind of getting a bump this morning. That's primarily, in my opinion, due to the anticipation that the Fed is going to turn a little bit more dovish, having seen the stress in the markets over the past week.
Few days,
although I gotta be honest with you, a decline in stocks of 3% should not be considered as stressful by any means. And considering the inflation figures we have, well, the central banks are really getting on the nerves of bondholders, I imagine.
Yeah.
But let's see how this goes. Let's see if the Fed sticks to its line and introduces some more persistent language, such as guys, a 5% correction in the stock market is not going to make us change our minds.
Yeah. I was just going to say that at its worst, the S&P was down just over 5% from the all-time high. Right now, it's down 3.4% off the record high. So it's nothing significant in the grand scheme of things. But obviously, that is subject to change because we have seen some technical damage now as we transition to a technical analysis from a macro point of view. We've seen the S&P 500 break its bullish trend line that was in place since the start of March this year. That has been taken out. I think some of the other indices, like the Dow, has already broken a more longer term trend line. Obviously, this is a short term trend line, but if I draw the longer term, connecting the March 2020 low to the more significant lows that had been created since, for example, this one, you can see that if I extend this line out in the future, you can see that the Dow had already broken that some months ago, and ever since then it has been struggling to gain further upside momentum. And more recently, the Dow broke its shorter term trend line, and that led to further weakness, which we saw towards the end of last week and at the start of this week, before things have bounced back. I think that the rebound is a combination of a short covering, is a combination of short covering and on the back of news that the US is going to allow vaccinated people to travel to the US from Europe and UK and other places. So that's obviously
has been interpreted by the market as a positive sign in terms of us moving on from the damage COVID has done to our economies.
Yeah.
However, this this happened. This happened at a time where when we're seeing pretty high case numbers in the US, and at this point in time, vaccination rates are basically high enough for the US government to have enough confidence to allow traveling back and forth. We'll see how that goes.
Yeah, I'm just drawing a few things on the chart just as we speak, just to see where we could possibly see potential resistance come in after this corrective bounce in this short-term bearish trend. Obviously, the long-term trend is still bullish, as indicated, for example, by the still rising 200-day moving average, flattening out a little bit, but it's still rising. Yeah. So the longer-term trend is still bullish. But short-term, obviously, we've seen the breakdown below the bullish trend line. Price or the index in this case, I think I'm just going to delete this one because it's not very, it's not a true reflection of the short-term trend. The index has been creating lower lows and lower highs. So any short-term recovery is going to be met with some resistance, I feel. And the line in the sand, for me, in the case of the Dow at least, is this zone here. Previously, this area was support for a while before we broke below it. Ideally, from a bearish point of view, you don't want to see the index come all the way up here again. So where it is at the moment, if it starts to retreat, keep an eye on the lower time frames like the hourly or 15-minute charts. And if you start to see some or even lower, if you start to see some weakness coming into the market, you see a short-term breakdown in the structure of price or index in this case, then that could lead to fresh technical selling that could take us initially below this week's earlier low. So I'm going to move this here. This will be the initial downside target. So people who have bought this dip, they will they will have placed stops below this low, right? So that would be a pool of liquidity that might get tapped into if the selling resumes. Below that, we have this low where undoubtedly there will be even more significant stops resting underneath. So we could yet see weakness come into the market despite the rebound that we've seen.
Just a little bit of just a side note on the fundamentals behind this drop here. We spoke about those last week during our weekly webinar. The Chinese property developer, which has $300 billion in debt, called Evergrande, has been basically slammed, and it's on the verge of announcing an official default. That's the one, Hong Kong exchange. It's this price is in Hong Kong dollars, so it's practically worth cents.
It's almost a zero, isn't it?
US dollar terms.
Usually when a stock gets this cheap, usually it goes all the way to zero. Because obviously the market doesn't expect the Japanese authorities to step in. For if they did,
the Chinese
Chinese authorities to step in.
The Japanese authorities are not going to step in. That's for sure.
Oh yeah. The Chinese. If they were, the stock price would have never got to these levels. Of course, there is still a small possibility that they might intervene, but let's see. It looks very unlikely in my view. But the stock is trading at I think nearly at fresh all-time lows. It's certainly its lowest level since at least 10 years or something.
We're back to its IPO levels.
IPO levels, yeah.
Yeah, the company has really struggled with raising money from its assets, which is obviously construction.
Yeah.
And the housing market in China is threatened, which is spilling over, first of all, into commodities. And the recent bout of weakness in platinum, well, iron ore, really, which is associated. I don't think it's that relevant to our listeners, since it's a very expensive contract in futures.
This is
but it's certainly something to have in mind, especially if you're trading the Aussie and the Kiwi and
the copper.
Well, copper is still pretty much near all-time highs still, because of the electric vehicles. But basically, due to the crisis in the Chinese construction sector, which accounts for about 70% of global resource consumption. In some, in concrete, for example, if I'm not mistaken. The point being that commodity currencies have been underperforming recently compared to the euro and the pound, and obviously the dollar, which has been rising in these times of stress. But
this is the EURUSD, for example.
It's ever since March. It's been on an upward trend. So this is something to watch out for. Some pundits are saying that the Chinese government will eventually balk and bail it out. However, if they haven't done so until now, well, when are they going to step in? And yes, you're putting up another chart that is important, and that's the dollar Chinese yuan.
The Chinese yuan has been weakening, in the last few days.
It's not dramatic. Obviously, trade flows are still supporting China's currency very much, but something to watch out for. Anyway, shall we talk about the Japanese yen?
Let's talk about Japanese yen, because
the most boring pair of them all. But you know how, guys, these things play out. The tighter the range, the higher the implosion to one of the sides, upside or downside. So let's see how this resolves. For now, it certainly looks that it's super inconclusive. What's going to happen next? The range is getting tighter and tighter. We are between 109 roughly and 110.50. Those are the levels that I'm looking at. 10.50 to the upside. The price visited these levels a couple of times over the past 10 days. Or so, and the support level at 109 has been tested about 2 times, if I'm not mistaken. Well, even more, you could say, if we look back. 109.20 to be more precise-ish, something like that.
We have seen weakness in the stock markets, and the dollar yen tends to track the equity markets quite closely. So if you believe that the stock market selling is going to resume, we could see some weakness coming to the dollar yen, especially if the Federal Reserve turns out to be less hawkish than expected on Wednesday evening. I think a lot of people are just sitting on their hands, awaiting the outcome of that policy decision. So,
yeah, it's the first Fed meeting of the active trading season. The summer is almost officially over in the
northern hemisphere.
Northern hemisphere. So we're looking looking to see how that evolves.
So I think that the focus this week is beyond central banks. It's all going to be about risk on or risk off. Okay, so today is risk on. Yesterday was risk off. I think given the technical damage some indices have incurred in recent days, I think sentiment is still very cautious. So it may be worth keeping an eye on the yen crosses, and if we see further weakness in sentiment, then we could see further falls for the Japanese yen pairs. So, for example, the pound yen could be a prime suspect. This pair has been printing lower highs. There was an attempt to break above the bearish trend line a few days ago, or several days ago, failed. We created a bearish engulfing candle. Since then, it struggled to move in either direction, then started to rise a little bit, but then the attempt to break out failed once again at the bearish trend line before that big sell-off happened on Monday. Today we are seeing a bit of a bounce back, in the pound yen, along with all the other risk assets. This could just be a short covering rally. So there is a possibility we may see the lows underneath this low and this one get taken out in the coming days. So this is something I would keep a close eye on, because we may see something like that happen in the next few days. So if you're looking for any specific levels, as I zoom in a little bit, I think 150.60 is a key level. I would argue on the hourly chart, this level here was the base of the most recent breakdown, and it hasn't been retested on this time frame. So that level could be important to watch for potential resistance coming. Otherwise, an alternative way to trade this would be to wait for the most recent hourly low to be taken out. So this was the most recent low prior to price making a higher high above this high. So if the market were to come back below this level, then I would look for a retest of this to take us lower. So that's an alternative way to get on board on the short side below below levels like this. So if the market continues to print higher highs on the hourly time frame, then what you could do is move this to beneath the most recent low prior to price make another higher high, and then you could see try to trade the breakdown of that level. So right now this is the most recent low at 149 149.60. Similarly, if you look at a few other yen crosses,
the euro yen has also been trending lower for a while now. Can you switch over to the weekly time frame, please, just for some for some contrast? So we tried to break through a descending trend line, and we did so successfully. Are we going to retest that line? Let's see. I would, it's probably even
127.
What's interesting in these pairs, both the pound and the euro Japanese yen crosses, is that they tend to be trendy ones on a longer term basis. And yeah, that's something that traders should have in mind. Like you have these bouts of uncertainty that cause dramatic rallies in the Japanese yen as Japanese investors are repatriating their investments from all over the world. And you have these periods of, increased risk appetite when the reverse is holding true.
Yeah. So going back to the daily time frame, previously we were expecting the euro yen to sell off from the shaded region, which had eventually did it. Took its sweet time, didn't it? Tested this area a few times before selling off. We can get rid of this now and move this here, because if it breaks this high, I think that will have changed the whole technical dynamic of this pair. So that's the line in the sun as far as the bears are concerned. In fact, I could even move it above this level here. I would say this spike high right there, and call it short-term bias bullish above that level. Yeah, so if we break through this level, then I would say it's bullish, because we've tested this level and we sold off sharply. There's no reason for price to go all the way there again and then sell off, in my view. Where it is right now is testing resistance, because this level was previously support. We deviated below this level for a while in here, and then once it reclaimed that level, it went on to rise sharply. We are testing this level again. Yes, we've broken below it yesterday. So we are retesting it from underneath. So this level 1 support resumed its role as support here, providing some confirmation here before breaking down yesterday. Now it's being tested from below. So
now the question is whether it's a false breakout.
Yeah. There's always that, isn't it?
In the terms of your educational videos on our YouTube channel, which you guys should definitely check out.
Yeah, we have a whole page on or playlist, I should say, on trading the failure of key reversal patterns. The series here. So how to trade the failure of, for example, continuation patterns, double tops, etc., hammer. So that could be an example here that, is this a fake out or whatever. So far, it doesn't look like it is, because we've closed below it. But if we were to go back above this level, then that would confirm that it, in fact, is. And then we would consider the bullish scenario. But for now, as things stand, I think that the most likely scenario is that we break lower, take out the low that was created here, and then possibly fall to 127, which is the weekly support level we shared with you, before the market bounces back. So that's my base case scenario for the euro yen.
All right. So shall we look at the elephants in the room? The euro dollar and the pound dollar, the most traded currency pairs.
Euro dollar. This chart is looking really messy, so I'm just gonna remove everything, okay, and start with a blank canvas. The weekly chart here is looking quite bearish. Euro dollar, because last week we created a bit of a hammer. Look at this, okay? So by previous week high.
So let's see if the hammer turns into a sledgehammer.
Yeah. So there was an attempt to break above the high of the previous week's candle. This is very similar to, for example, this breakout here. It failed, and then you can see that it went down for the next subsequent days.
And we've been testing the key 117 level last week and this week again. So, sorry, last month and this month again. That's definitely something, guys, to watch out for. It's
a very important
the
level.
most important level in the euro dollar right now. And we are at the cross point. We do have, if you can switch back to the daily chart.
Sure, just give me 1 second.
Yeah.
Okay, so I'm just marking out the previous week's low just for reference. Okay,
Yeah,
so
the range is here
range.
between 119 and 116.60.
Sorry, was
roughly.
that the weekly chart? Oh, that was the
Yeah,
monthly
yeah.
chart. Sorry.
No, sorry, that was the monthly chart.
Yeah,
So
sorry, my
you
mistake.
have
So
the,
whatever we said, it was relevant on the monthly basis. This is the
yeah,
ranges from the previous week. Okay.
yeah. We're testing the lower side. We've tested the lower side yesterday,
Yeah.
and we are hovering around unchanged so far today. I do believe that into the Fed meeting we're going to remain here basically, around the current very tight range.
Yeah.
But depending on what Jay Powell says tomorrow, we could have another round to the upside towards 119, or a breakout below 117.
Maybe.
So that's something to watch out for.
So just as Victor was talking there, I drew two boxes here just to highlight something. Previously, we had this bullish-looking candle right here, the hammer or doji candle. There was an attempted breakout here above that on the next day,
which miserably failed.
You know, we've got another similar candle, and we have attempted to break above it, and prices start to drift back below that level. Yeah. So could this be another such scenario? If that's the case, then I would expect 117 to give way, leading to a potential drop to below this level next. The most significant low that was created here at 116.
Yeah.
That's something I'm if you want confirmation, then maybe wait for price to move back below the previous week's low, and we can be more precise about that. You know, on the hourly time frame. This is the hourly time frame. You could, for example, draw a trend line here, and maybe see if we go below this trend line, and then try to possibly look for a short trade. Below, going back to the daily, below 116. There's this level here that was last tested at that was created in September, last tested in November, and that could be the next downside target for the bears. So around 116 area. Beneath that is
overall, do you think that this level could be less relevant considering the fact that we've been consolidating for so long?
Yeah, I agree. I don't think it's going to hold much. If we see a clean break below 117, I would expect rates to decline to 115, towards 115, without too much of a pause around 116. But we may see, slight bounce there.
Of course.
Yeah.
Everything is possible as usual. Don't take us at face value.
So right now, the key takeaway point from what I'm trying to say is that the trend is, yes, it's going sideways in this range, but it's trading in the lower half of that long-term range, and it's looking quite heavy. So as things stand, I'm leaning more towards the bearish than bullish argument, but at the same time, you know, we've got the FOMC meeting.
Jay Powell can throw a hammer into that view.
Exactly. So if he turns out to be very dovish, that could send the dollar tumbling, and everything against the dollar could rebound, including even the euro.
So just a side note here, we've been surprised by Jay Powell's hawkishness this year so far.
Yeah,
like we usually expect him to be like a little bit more dovish and cautious, but he's been consistently more hawkish than the market expects.
Yeah.
So Let's see.
And I think it's refreshing to see the Fed being a little bit more hawkish because the data is telling them to be
Sure.
more hawkish. Um,
Yeah.
Normally they're like, okay, this is going to be temporary, the rise in inflation, but they have started to acknowledge the fact that inflation is rising now.
Yeah, and many CEOs on earnings calls have been, jumping on the bandwagon of saying that inflation is proving to be more resilient than they previously expected. So something to keep in mind there. Fawad, we just lost you. I don't hear you.
Sorry, I put myself on mute
Yeah.
because it's a little bit loud here in the London office. I don't want them to disturb you.
Yeah.
I was going to say that the pound is going to be in focus as well this week. We have the Bank of England meeting coming up on Thursday. Very important because pressure is growing on the Bank of England to do something about rising inflation, rising inflationary pressures. But it looks like the market is expecting the bank not to do much about it just yet. Hence, the pound has been weakening. So if the Bank of England is not as hawkish as some people are expecting it to be, for example, if the Bank of England maintains if what do you call it MPC members
Yeah.
if they vote once again 8-1 in favor of 9-0 in yes 8-1 in favor of keeping QE unchanged, then that could be bearish for the pound. Obviously ahead of the Bank of England meeting we have the FOMC meeting, so the pound is going to see elevated levels of volatility this week. So where do we expect it to go from here from a purely technical point of view? Well, the trend is bearish. Price is below the 200-day moving average. It's fallen just below the previous year's high. 2020 high was this level right here.
On the last trading days of 2020.
Yeah, that level has been tested a few times and it held. We broke below it briefly here. Price recovered.
Yeah.
And then it fell again. Again, it recovered. We are once again trying to break below that level. So it's repeated failure to hold above that level, which is making me a bit bearish on the pound at this stage. So right now, the pound has bounced off the support level here, which was the point of origin of the last breakout. So that makes perfect technical sense. It is now retesting the 2020 high at this green level here, which is the lower bound of this resistance range, which was previously support. So around here somewhere is where the sellers need to step in if the trend is still bearish, which I think it is. So from here, I would expect the pound to do something like this. And then I don't know what it's gonna do like once it gets to these levels, 135. But 135 is my my downside target. From where we are at the moment. So let me just move that to 135.
So I don't have much to add except for monitor the central bank meetings this week.
Indeed.
Shall we move on to gold?
Yeah, sure. Gold is.
We had a friendly spat with Fawad last week. When he said that it's not going to trade below 1800, and I wagered it will. But
I said to Victor I said to Victor that we'll never see gold go below 1800 in my life. Obviously, I was joking there, but it collapsed, didn't it, because of the strength of the dollar. It has since bounced back from this support area, which we highlighted as potential support.
And it's forming kind of inverted head and shoulders pattern with both shoulders in the 1750 area and the head around 1680 during that crazy Monday when precious metals fell off a cliff.
So this is the inverted head and shoulders Victor's talking about. Gold is still in danger of falling further because the technicals are not showing too much of a strength, even though we've come back up in the last couple of days, and we're testing the highs from previous couple of days here at around 1767. It
We're seeing
really needs
once
to hold.
again some J Powell caution, and as interest rates moved higher, gold prices dropped lower. So obviously, like the other side of this argument is that when the stock market is in distress, gold prices tend to act as a safe haven, and gold is bid on those really bad days for the stock market.
So from where it is right now, we may see some. Let me just get rid of this trend line. It's no longer relevant. We may see some strength come in gold and cause prices to rise to the next level of resistance around 1780. Even 1800 is not out of sight, I wouldn't say. But we need to see a higher high for gold to decidedly tell us that the trend has turned bullish. And for me, that higher high would come in the event price goes above this bullish candle that that failed previously. So I've put an alarm there, and if we break 1808, ideally on a daily closing basis, that would be the line in the sand for me. And at that point, I would turn bullish on gold once again, because then we will have confirmed the inverse head and shoulders pattern as well. So that's the level for me, 1808, before I turn bullish on gold. Otherwise, anything we see in the interim might be a recovery in a bear trend. So potential resistance, therefore, could come in at around areas where previously price was finding support, somewhere around here. And so, we have to be careful if you're trading gold on the long side, even if equity prices are struggling. There has been times where gold has basically followed the stock markets, and it's all to do with the central banks really messing up the dynamics of gold being a haven asset, because when central banks are printing money left, right, and center, every asset has benefited from that, with varying degree of success. But when the opposite happens, obviously, all risk assets, and gold is now considered more of a risk than haven asset, because if you look at the correlation between gold and the S&P 500, in the last 5 or 6 years, there's been more occasions of positive correlation between the two assets than negative, which would have been more the case in the previous years. Anyway, that's the situation with gold. There's a potential inverse head and shoulders, which is technically a bullish sign, but we need to see the confirmation. And for me, that confirmation comes in if we break 1808.
So we're almost out of time, and I wanted to ask our audience if they have any questions and whether they want us to take a look at a certain pair or cryptocurrencies. Why not?
Why not?
Bitcoin has staged a comeback this morning after testing previous area of resistance that has obviously turned into support. The 41,000 area. We're looking very positive today. It could be a point of a new potential rally, I would call it, but let's see. The potential resistance that Fawad has just highlighted around 43,500. That's something that traders should be looking at now that we are on the verge of closing above 43,000.
The reason I have selected this particular level is because previously, as you can see, it is where the rally started, and then I'll just show you with the So you see from here that the rally started, and it looked for a while that the next phase of the recovery was on the way, and Bitcoin held its own above the 200-day moving average for a few days before it collapsed on Monday. So this is the base of the previous support zone. If this sell-off on Monday was a turning point, then surely we should expect to see some resistance around this area. So I am expecting Bitcoin to go down from here. And I would be wrong, obviously, if there's always the case that we may see some deviation, that we would go back in the range and then Bitcoin could do whatever next. But my line in the sand is this level here, this level here at 48,000. Call that 49,000, which was the most recent high prior to the breakdown. So there is a possibility you may see Bitcoin go and test the 200-day before falling once again. But the key level of resistance in the short term is this area I've highlighted just now. One thing I would say about the bear trends, you will often see lots of fast moves in the opposite direction. For example, if you look at this zone here, as we await your questions, guys. So don't forget to ask us questions. So if I put a red box here, you see in this phase here, Bitcoin dropped sharply, and it took out the previous low. So that's when the trend changed, right? But then we saw a massive recovery here, and as the price of Bitcoin was closing in on 60,000 once again, everyone was calling for fresh all-time highs. It never really happened. But what I wanted to highlight was, look how Bitcoin staged sharp recovery attempts on several occasions before price went down. And so what I'm trying to say is today's hammer, although it looks bullish, because it's a hammer, it comes in on the back of a sharp fall and a breakdown from this bullish channel. So
it could be just a trap.
Indeed. So we can't see any questions, which means therefore that we can conclude today's webinar. Let me thank you for joining us live, and for those of you who couldn't join us live today, I'm sure you will be able to join us next time. And you can do that by going to market analysis on our website, go to live webinars, and here you will see a list of upcoming webinars, which you could register to. This was today's one, and we have another one coming up on the 28th, which is next Tuesday. So I hope to see you guys then, and take care. Be careful out there.